Ever pondered on how a company's profit or loss is measured? A tool called the income statement comes into play, which measures a company's profit or loss over a specific period of time. It's a critical document for tax purposes, as it records the sales a company generates. Now, the taxes on these sales can be reduced by the expenses incurred while generating those sales. So, essentially, a company's profit equals revenue minus expenses. And what a company is taxed on is the net income, which is profit minus tax. Sounds simple, right? But income statements can be quite complex, especially with the varied categories of expenses. Nevertheless, as analysts, it's crucial to identify major categories within the income statement to facilitate proper analysis. In fact, it's advisable to categorize income statement line items into 9 major categories. These are revenue or sales, cost of goods sold, operating expenses, other income, depreciation and amortization, interest, taxes, non-recurring and extraordinary items and distributions. So why categorize? This will enable an analyst to easily understand the major categories that drive profitability in an income statement. Also, it allows for comparison of profitability between different companies, an analysis very important in determining relative valuation. Let's delve deeper into these categories. First, we have revenue. This is the sales or gross income a company has made during a specific operating period. It's important to note that when and how revenue is recognized can vary from company to company and may be different from the actual cash received. Revenue is recognized when realized and earned, which is typically when the products sold have been transferred or once the service has been rendered. Next, we have cost of goods sold. This is the direct costs attributable to the production of the goods sold by a company. These are the costs most directly associated with the revenue. This is typically the cost of the materials used in creating the products sold, although some other direct costs could be included as well. Now, gross profit isn't one of the 9 categories listed, as it is a totaling item. Gross profit is the revenue less the cost of goods sold, and is helpful in determining the net value of the revenue after the cost of goods sold is removed. One common metric analyzed is gross profit margin, which is the gross profit divided by the revenue. For instance, consider a business that sells cars. If a car is sold for $20,000 and it costs $5,000 to manufacture the car, the revenue is $20,000 and the cost of goods sold is $5,000. That leaves us with a gross profit of $15,000 or a 75% gross profit margin. In summary, the income statement is a vital tool for understanding a company's profitability. By categorizing the line items into 9 major categories, an analyst can gain a clearer understanding of the factors that drive a company's profitability and make meaningful comparisons between different companies. It's all about understanding the simple equation: profit equals revenue minus expenses, and net income equals profit minus tax.